The Spin-Off Podcast Network.
K-pop to me means more than just listening to music. It's learning to be myself.
The Spin-Off's new documentary, K-Pollies, follows 3 Pacific youth obsessed with K-pop. In a one-off documentary, see what they've found in Korean pop culture and how they bridge it with their own.
When you start dressing, looking different, everyone side-eyes you. But in K-pop, they're just like, no, like celebrate yourself.
Watch K-Pollies today at thespinoff.co.nz/videos. Made with the support of New Zealand On Air. You're listening to Business is Boring, a podcast that reckons it's anything but. Business is Boring is brought to you by SparkLab, offering inspiration and practical advice to help businesses find their edge. To hear more about SparkLab, including details about the latest events, workshops, and business tools, visit sparklab.co.nz. And now, here's your host, Simon Pound.
You're listening to Business is Boring, a podcast that reckons it's anything but. Business is Boring is made by The Spin-Off with help from Callaghan Innovation. Here's your host, Simon Pound.
You might have heard of the PayPal Mafia, a term given to people that came through PayPal and then went on to invest and found and help grow other tech companies. People like Elon Musk, Peter Thiel, Reid Hoffman, companies like Tesla, LinkedIn and Yelp all trace back to PayPal. Well, in New Zealand, I think we have our own version of that, the TradeMe Mafia. The people who helped that company start, scale, grow and sell have gone on to use the capital they built up, both in terms of money that they made and the social proof of their good judgment and business sense, and they've gone on and fostered a lot of the local industry. It's a theme of this podcast, and one of the key members of what I'd call that mafia is Lance Wiggs. You can draw one of those detective show style photo boards with all the lines, and there'd be lines all over Business is Boring for today's guest. Lance has been a director, investor or advisor to many of the people on this podcast. Wierdly, Onceit, Vend, Populate and Timely, to name a few. Lance has taken his experience and created a vehicle to help fund and propel high-growth companies forward with Punakaiki Fund, and he's a prominent commentator on local high-tech companies. We get him on today to find out about his career, his fund, and why he keeps doing it when he's probably done well enough to do a lot more bike riding, which is one of his hobbies. Thank you for joining us today, Lance.
Thank you. Let me just a couple of corrections here. So we have a TradeMe Mafia in New Zealand, but unlike the PayPal Mafia, only a few of them actually made a whole bunch of money. I think what's really interesting about the TradeMe Mafia is, and I was just looking now to see where everyone's landed up, it's a real diaspora. You've got people like Nick Wakelin, who's... actually, Nick wasn't at TradeMe, but he did some work for them on the side. But, he's flipped out to 2 other companies. Cameron Melpot and Jamie Howell, they were the first... along with Nigel Stanford, they were the first spin out of TradeMe. They started a company called StarNow, which has gone on to be very successful. StarNow now employs a bunch of other TradeMe expats, including Alan Howard, the ex-head of Dev, and Tim James, the guy who did the Kevin the Kiwi, and Jessie Morgan herself as a director there. And it just goes on. Tony Barrett, Sarah Pinnell, Kirsty Grant. These are sort of people that have been out there and doing things with lots of different people. Michael O'Donnell, Mod, he's flipped in 2 or 3 different places, and now he's up here in Auckland working with a company that Sam Morgan actually owns. Alex Falla, obviously we both know Alex pretty well from Vend, and I should note that Punakaiki Fund is an investor in Vend. Love watching you guys at work. Richard Humphreys he's at Trade Tested, has formed his own mafia, really, and around Trade Tested and a bunch of other stuff out of TradeMe, and then Ryan Baker and Andrew Schofield with Timely, and the list just goes on and on and on, and it's really fun watching these folks go through and link up with more and more people across New Zealand. And then kudos to people like John McDonald and Jimmy inside TradeMe who have stayed there since I left and before I arrived, really, or when I left in 2006. So it's just wonderful to watch. And you wanted to be at TradeMe in 2004, 2005. That, if you're the internet in New Zealand, that's where you wanted to be. It was an amazing time, an incredible place, likely not to be repeated in that company, but being repeated in many other places and many other companies throughout New Zealand at the moment.
Yeah, tell me about that, because one of the reasons that there is such a, and it's so cool to hear those names that you don't hear all the time, because you always do hear the Rowan Simpsons, the Sam Morgans, Vaughan Rousel. He was in TradeMe as well. You hear those kind of like currently very prominent people, but it's that next wave that it gets really exciting. Tell me how it was. What was it about the company then that made it such a place?
You walked in the door. So I was always a consultant. I was never an employee, and I was 3 days a week, but I'd often stay late. Another guy, Paul Gold, he and I would be there late at night. Everyone else would leave at 5:30, so I thought it was very strange. But the thing is, you'd walk in the door in the morning, and everyone's there, and there was a quiet hum, and everyone's just working, very, very smart people, working incredibly efficiently and effectively. This is not goofing around kind of stuff, although it was a really nice feeling in the place. And just, getting stuff done very quickly and very effectively, seeing the results immediately on the site. And it was just, that was it. It was just a good, this very hard place to get into, very hard to become an employee. Clearly, I didn't make the cut. Very easy to leave, which is a lesson I pass on to many early stage companies these days. Make it hard to get in and easy to leave.
What does that mean? Sorry.
To just have very high standards in your recruiting. Don't settle for she's good enough, he's good enough. And if someone's not a culture fit in particular, it's obviously you work through a process and manage that. But really, it's better for everyone when someone's not performing if that person moves on, either turns around or moves on. And obviously, there's more to it than that. You've got to dig into why, what's going on, what's happening outside of the work, and so on. But I've never really seen a case where someone's been asked to leave for performance issues and it hasn't been best for everybody.
What made TradeMe the place? Was it that there were not other high-tech, high-value companies, high-growth companies, as many around, as many options?
No, I think the surprising thing about TradeMe is, people say, it's just like eBay. And yet, it was much better than eBay. It was the site was much easier for end users to navigate. So the first lesson I take from that was the end user centricity. Usability was everything at TradeMe. Does it make the user experience better? Does it look after that process? And so that was a discipline within the company that held by everybody. The thing about TradeMe is that they made very few mistakes, and when they did make a mistake, they fixed it fast. And so it was well governed. You had a good board. Sam could run rings around them, and his dad was on there too. So, but they did have a process. They did have good management, and they found mistakes, fessed up to them, and changed them generally very, very quickly. I'm still angry about the travel bug naming, but I'll get over that eventually, I'm sure. And that was good. And I enjoyed working there. Doing my little thing. Everyone else enjoyed the same, and it was just a good bunch of people doing good work.
And another thing that company really represented for New Zealand was when it sold, it seemed to be this big number, and it was almost like the international tech frothiness had come to visit New Zealand. But as time's gone on, that 750 million figure seems like some pretty amazing value.
It was, and my counsel at the time to to Sam, I guess, and Richard was, it's worth much more than this. It's worth over $1 billion. And they replied, sure, but there's 750 million here. And I completely agree with their philosophy of, take the money that's there. 2001 was very still ringing in all of our minds. We had these valuations that were frothy and that disappeared overnight. This was a different business. It was, foundly held, great foundations, I guess. And but I understand why they did it. They're able to take the money, change their lives immediately, and off you go.
And change a lot of other lives. They've gone and used that capital to help foster another whole generation.
Sure, some of them have, and good on them for that. I think overall the TradeMe lottery winners as we fondly called them. They actually were really responsible with their newfound wealth. Almost all of them weren't flashy with it. Most of them committed back into the ecosystem, and really good on them for that. Some of them kept working, and they didn't necessarily have to. So a lot of appreciation for the way they went about their business afterwards.
And that brings us quite nicely to Punakaiki Fund, which has been, we've had a few of the guests, as I mentioned, of this show, companies in your portfolio, and it's been a very public process where you've tried to set up a fund to provide for supporting these high growth companies, and you've done it in a number of public ways. Tell us about getting started in those first kind of setbacks.
Yeah, so it's actually the second PFL. The first PFL was Pacific Fibre Limited, but actually, when just after the deal was done with TradeMe, I made an aside to Sam and said, "Okay, that's great. Let's start a fund. Let's invest in some companies." And he was, "Oh, no, too early. I can't think about that." And it was. They were all just grappling with the fact that they just changed their lives. But I'd always wanted to start a fund. That's why I came back to New Zealand. If you look at my application to Yale, I want to come back and do this stuff. And I just couldn't get it away for many years because I didn't have the connections on either the fundraising side. And I did have the connections, I guess, on the deal flow side. And I really kept a foot in that community for all the way through. And it got to so we did Pacific Fibre, and that was a bit of a distraction because I was going to do the fund then. But I was always missing an offsider, someone to a partnership. It was what I was looking for. Someone who could work through a lot of the process sides of the things, who can back me up because I'll leave things on the ground. And I found Chris Humphreys at Pacific Fibre, which is great. And when that stopped, we got together and founded LWCM, which is the company that manages Punakaiki Fund, and spent a year on developing the concept and pushing it around. And then we went public. We wrote a prospectus, which is a brutal endeavor. We got a board, and we did a public offer, not to IPO, but just to say anyone can invest. And the good thing about that was, I know a lot of retail investors. I don't know anyone really in the investment community in the big end of town. And when we went and talked to them all, they didn't really understand the space. So the reason there's an opportunity with Punakaiki Fund is that we understand that this amazing space of high growth companies is underserved by capital. But when we went and talked to the people with the big money, they didn't even understand that. And and when they do apply the money, they generally put it into things like GeoOp, and it just disappears. So that failed. We raised 3.3 million instead of the 5 minimum and 20 that we're aiming for. That was in sort of October, November 2013, and that the night, so we extended it once. The night that 5 o'clock on the last day of the offer, when we were shutting it, I was on stage at the NZICT conference, being the last speaker. And so I had to do the rah-rah session, and it was pretty much, we just went out there and failed. And what's the worst that can happen to us? Really, what's the worst? Come on, bring it on. And you know what? We're still standing. Lost a bunch of money, lost a year, whatever it is, but we're still here. Bring it on. And we went out again, and that was great. Good, it's self-motivation for me too, because I had to write that speech and talk about it, and it just sort of, made me realise, yes, it's not wasted. We went out again the next March, took the investor list we had, emailed them and said, if you're a wholesale investor, click here. Read this investment memorandum, and we got $1.5 million. And we gave it to Timely. We gave it to what's now called Raygun. It was Mindscape, JD Trusk. We gave it to Influx, and we gave it to Vibe Communications. And Influx is they've had a few tough times along the way, but they're growing and they're still there, and good company, good people. But Timely, Raygun, and Vibe have just gone nuts, completely nuts, and so we did well. And then we raised more money during the year, and more again, and more again, and more again. And now we're currently doing a raise. Check out our website, punakaikifund.co.nz. Closes on Monday. Currently do a raise. The fund size before the raise is $27 million. The share price, or the net asset value per share, has gone from $10 when we started in 3 years ago now, 2014, April. It's gone from $10 to $22.46 per share. So, and we just keep raising money, putting it into companies, and currently we have 19 companies and it's so much fun.
$5 million is, even 3 years ago, that's 2 or 3 houses in an average street in an average suburb. And out of that level of capital, you guys have helped to foster companies that have gone on to have real employees and real exports and do real things for the industry. And yet there's so much capital available for unproductive assets, and it's so much harder to get the money for the productive assets.
Yeah, the issue that we're facing is that it's really easy for people to play in real estate. And I've always said, I looked at real estate and I bought a house years ago and I sold it and made good money in it. But I thought, you know what, this is not a game I have a competitive advantage in. I'm good at, I could do it, but I'm not really organized enough to be a good landlord. You know, you don't need to sort of go to Yale and do all that stuff to do that. So I won't play in that space. I'll play in the space over here, which is where I can get an advantage. And, you know, but I can completely understand. I've got friends doing the same. They're like, well, I've got a bit of spare cash. I'm going to buy a house or apartments or rent them out. And it's the numbers even now still work in some places in New Zealand. And I can't really argue with it. And fundamentally, it comes back to the tax system giving a great advantage to it. You know, as an investor in high growth companies, we have no capital gains tax. It's unreal. So the actual advantages are with us too. So you can get incredible returns in New Zealand by investing in high growth companies and just holding those investments, and you don't pay any tax. How's that not great? Yeah, and yet, because of I'll rewind a little. In 2002, 3, 4, the New Zealand Venture Investment Fund was set up. And they co-funded the beginnings of the VC industry. They co-funded several venture capitalists, almost all of whom failed. They might have succeeded in some other way, but they failed in the core of being great VC investors. I talked to one on the other day, and they just missed their hurdle. They eventually sort of worked all these things out and got it, but that wasn't anywhere close to smashing it out of the park, and the capital could have been better deployed elsewhere. And I think the flow-on effect from that has been that people have looked at the industry and thought, wow, it's a good way to lose money. And you're right. You give your money to the wrong person, invested in the wrong company, it's a good way to lose money very quickly or very slowly. And that's something we look for in companies when we invest. We say, well, can you, with this money, get to a place where you don't need any more money ever again? And we look for the answer to that to be yes. And then when they are getting towards that place, they often say, well, hey, how about some more money because we'd like to accelerate our growth? Because
we've used the money we had responsibly and got to the place we told you we'd get to.
And, look, generally you don't. I mean, generally people overestimate what they'll do. But then you get the occasional timely who just smash it right on their curve and get to profitability and keep going. And that, that's wonderful to watch.
What kind of things do you look for in a founder or a co-founders or a company that comes into your fund?
So we start with a pretty simple approach. We start with the end user, who is the person using the product. So think about TradeMe, that's that whole end user centricity. Is the product easy for them to use? Are they listing stuff? Are they selling stuff? How are you placed versus the competitive options for that end user? That sort of thing. How's the product? Is it great? Are they using design? Do they have a niche that's global? All that sort of good stuff. We look for a tight global niche if you can, or good understanding of where they're going. Then we look for the way to get money. So how good are you? You might have the best product in the world, but you need to sell it as well. And it's quite often different people that use it and pay for it. And so how do you get to market? Well, let's have a look at your sales machine. And it's generally at the beginning, it's the founder. And I've had a lot of conversations over the years with founders to say, well, actually, you're it. You are the salesperson until you get to a certain stage where you can afford to hire someone else. And so we look at the sales engine and how that can grow and whether money going in is going to accelerate that or not. Then we look at the people, obviously the founders themselves. Good people goes a long way. Don't give your money to psychopaths if you can help it. But people that are recommended to you, people that like people, it's people that people want to work for. All that sort of stuff, people that are self-aware. We're not looking for people who necessarily have done it before or who are going to be great CEOs of a $100 million company. We back them to learn that on the way. And pretty much anyone can learn that. It's a learnable thing. And maybe at the appropriate stage, do they have the right board and all that sort of stuff. and are they getting good stuff? And then finally, we look at the numbers. But if the first three things aren't there, the numbers aren't going to be there either, or you don't believe the numbers that you see. And the classic, thing of an early stage founder is the very early stage ones they draw a hockey stick curve to say, look, I'm going to get all this revenue, and I don't believe that. I'm not even going to look at that. And I don't even look at the forecasts that companies provide. It's garbage when you invest. And the main thing is tell me where your next 3 months worth of business is coming from. I kind of want names and ranks and, where are they in the pipeline and that sort of stuff.
What advice do you give people who say, I've got an idea and I've got this company and I want to do this? How do people put their best foot forward when they come to see an investor or a fund? A sophisticated investor or a fund.
So what advice do I give to people with an idea? I say go read Bill or Let's Disciplined Entrepreneurship and just follow that process. Which is, you don't have to spend any money for quite a while, and you'll find out whether you've got something there. For people that are looking to raise money from investors in New Zealand, and so part of what I've done in the last few years is work through NZTE on this program called Better by Capital. I helped over 100 companies, essentially stopped now, helped over 100 companies in 2 to 3 or 4 hour workshops who are on that journey. And for a good chunk of them, I'd say, look, raising money is hard. It's really much easier for you perhaps to raise money from your customers. And so maybe put your prices up, maybe differentiate your prices a bit more to have a higher end product. Maybe look at your costs. You've got some obvious costs over here. Maybe rather than founding a company and raising some money and paying for a lot of developers, and paying yourselves big salaries, maybe you should do what all the other founders do, like Vaughan, who just didn't pay themselves at all for the first while, and just really scrounged to make it work, because that's actually what being a founder, is often about. And then if you're going to an investor, there are two sorts of investors. There's the unicorn hunters, and then there's the folks like us who are really we're more private equity in some ways. Bring revenue growth, bring a track record of that shows that this business is, that I can believe the forecasts. So there's a curve in the background, like the TradeMe one from 2003-4. There's that curve there, so I can extrapolate that curve out and I'll get it there or thereabouts. So that's the main thing to bring, and show that you own the niche and you understand the niche. And there's a lot of BS out there. It's a lot better than it used to be honest. And most of the time in New Zealand, it's so hard to raise money, and often the people giving money in the angel clubs are not very. The result's not very good for anyone, and so it's best to try and avoid it if you can. So.
And one last question about being a director. So, as well as providing funds, you often take seats on boards of these companies. What does a director? What are your responsibilities as a director, and how involved, and what kind of things are you bringing to these boards?
So, your responsibilities as a director are actually enshrined in law, and they're pretty much if the company's bad, you'll go to jail. And I think you've got to take that seriously as a director. So a lot of people say, I want to be a director. So actually, you really want to think about whether you want to be a director, because you have this huge duty of care and fiscal diligence and what have you that you need to do on the business. If there's any fraud, you need to make sure you've got controls in place and so on. And often it's hard in our space. Things move real fast. And the main thing I look for there is the ability to say, okay, if I do find something, we're doing something about it now. And you expect to find holes. That they are. I mean, there's often people do their accounting wrong, or the accounting they're doing is set up for a company smaller than what they actually are at the time, and so on. So the role I play on the boards actually varies dramatically. So some of the boards, I'll chair the board. There's a whole team of people that are preparing things for the board. There's good inputs. There's a process during the boardroom. There are outputs. There are actions, and there's regular board meetings, and it's quite formal. And what you're trying to do in those meetings is focus on the important It's not really there's some governance-y stuff you have to do, but it's really, what are the key drivers of value in this business, and then making sure as you go through the year that you're cycling through all the different sides of the business. So let's look at people this month, and let's look at your strategy for growth into this new market, and so on. Your job as a board, by the way, is to help the CEO, the founder, and the founding team, and you're really their servant. So we have a founder-centric perspective where we back the founder, and other investors have some other investors have almost a reverse of that, where they back the business and they'll just switch out the CEO. So the board's function is actually to hire and fire the CEO and support that person. And if the company goes to the dust, that's the board's fault, not the CEO's. So other boards, earlier stage ones or ones that are kind of steadier state, it's really, hey, Lance, can we come and have a conversation about X? Or we've been approached by Y, or this deal is happening, can you help us over here? And it might be a series of phone calls. Maybe, sometimes they just get slammed for a little while on a particular deal or something going on. Or we have board meetings, but there are no inputs. However, we just pull out the same old Google Docs or whatever that we normally look at to say, well, here's the sales pipeline, here's what it looks like. And, everyone's on zero, so the accounts are really easy these days. So here's what's going on there, here's our cash. And then we talk about the strategy and whatever it is that they want to talk about at the time. So, and then as the companies get bigger, you want to put more people on the board. And you need to make sure you understand, and we have this with our own board. We've got an amazing board at Punakaiki Fund, Mike Bennett and John Berry and Mandy Simpson and Brian Hutchins, and they bring in quite a diverse set of perspectives. Maybe as a large investor, another one as a CEO of a major company who's raised hundreds of millions of dollars on an IPO. You've got the ex-COO of the NZX and a founder herself now, or a CEO of a high growth company. And a fund manager. And so you deliberately set that diversity up, same in the high growth companies, so that and you want diversity of not just where they come from, but what they are, who they are, the cultural values, that sort of stuff, as much as you can. And that's hard when you're a high growth company, if you're small, because you can't afford those people. They're not cheap. And sometimes we pay over $100,000 for directors. And generally you want to get directors who have invested because they're free. And I never get paid. None of the directorships we've got, we get paid for, because we think, well, we've given you money, it would be bad to take it back again. Does that answer your question?
It does. And,
good.
And from your perspective, you went to Yale and you told them that I want to come back and run a fund here. And it was a hard start to get going, but it's going, and the companies are seeing growth. I mean, how are you enjoying it at the moment? Is it what you'd hoped it would be?
The journey. It's all about the journey, I think. So, while it would have been fun to, and I've had several occasions in my life to have been involved in things where I could have made a lot of money, I've chosen the harder path and it's not about how you succeed. It's not about whether you succeed. It's about how. And so, to your question earlier, why aren't I motorcycling around the world? Well, I've done that. I did that before it was cool, and I'm raising I've got a young family, and we're I'm doing my life in reverse, I guess, since I'm settled roots down here in New Zealand again, and off we go. So look, we're not out of the woods yet. We're a $27 million fund going on 29 million, I guess, after this round. Sustainability for a fund is more like 150. 200 million, at least 100, and that's where we're aiming for our IPO. But the driver here is actually not, do we have a sustainable fund? The driver here is, holy crap, I'm so angry at the huge gap between the amazing companies that we see and the demand that they have and smart money in New Zealand. And, even the quantum of money is too small in New Zealand. We need hundreds of millions of dollars a year going into this space in New Zealand, and we're not getting it. And a lot of it is ill-directed, and a lot of advice has been given has been really bad as well. And I think that's the driver of what we're trying to do is we just want to solve this problem and help these people, and watch the founders go nuts. It's so much fun to see the ecosystem grow and to be on the surfboard, I guess is the way I put it, which is pretty neat.
Thank you, Lance Wiggs, the founder, co-founder, co-director of the Punakaiki Fund, who do have an offer live at the moment and will be going out to market again a number of times to get from 30 million to 150. So keep an eye on them. Thank you very much for listening today. Thank you to Jose Barbosa for producing the show. And if you are a fan of the spin-off, make sure you jump onto iTunes and download the app, the very best way to get hold of the spin-off.
You've been listening to Business is Boring, presented by Simon Pound. And brought to you by The Spin-Off and Callaghan Innovation.
From the Spin-Off Podcast Network, that was Business is Boring, brought to you by SparkLab. Make sure you're following Business is Boring wherever you get your podcasts. And for more information on SparkLab, visit sparklab.co.nz. Ready to rediscover the joys of cycling? With over 300 kilometres of cycle paths across Tāmaki Makaurau, jumping on your bike and going for a ride is such a fun way to discover the city from a different perspective. Cycling is getting more and more popular across Auckland, so now's a great time to join the hype and give cycling a go. Head to at.govt/cycling to find your nearest cycleway today. The Spin-Off Podcast Network.